The ARK Innovation ETF, ticker ARK, was once the rock star of Wall Street. In 2020, while the world was locked down, this fund exploded in popularity and in value. At its peak in February 2021, ARKK was up over 150% in less than 12 months. Cathie Wood, the fund's manager, was hailed as a visionary. But just a few years later, the situation has flipped. And in 2025, ARK could be one of the most dangerous places you can put your money. Let's be clear. ARKK is not just another index-tracking ETF. This is an actively managed, high-conviction, highly volatile fund that bets big on disruptive technology. Think AI, genomics, fintech, robotics, EVs. In theory, these are the industries of the future. But in practice, ARKK's approach carries massive risks. And if you're not prepared, this ETF could do serious damage to your portfolio. So what exactly is in this fund? ARKK typically holds about 30 to 35 stocks. As of early 2025, its top holdings include Tesla, Roku, Zoom, UPath, CRISPR, Therapeutics, and Coinbase. These are not blue-chip companies with stable cash flows and defensive moats. These are beta, higher risk, often unprofitable firms betting on future breakthroughs. Let's look at a few examples. Tesla, still a car's largest position, has seen its profit margin shrink due to a global EV price war. Chinese automakers like BYD and NIO are flooding the market with cheaper models, while legacy players like Ford and Volkswagen are aggressively scaling production. Tesla's stock is down over 30% from its 2021 highs, and its earnings are under pressure. Coinbase, another top ARKK holding, is directly tied to the crypto market, one of the most volatile asset classes in existence. In a regulatory environment that's still in flux, Coinbase faces constant risk of legal crackdowns, shrinking margins, and unpredictable revenue swings. Then there's Zoom, a pandemic-era darling that became a household name overnight. But now, the growth has plateaued. Enterprise customers are consolidating tools. Competition is fierce from Microsoft Teams, Google Meet, and Slack. Revenue growth is slowing. Profitability is thin. Stock performance disappointing. This pattern repeats across the fund. Many of ARKK's holdings are either unprofitable or trade at sky-high multiples based on speculative future growth. And that is where the danger lies, because the macroeconomic backdrop in 2025 is not friendly to this kind of investing. Let's talk interest rates. The Federal Reserve spent most of 2022 and 2023 aggressively hiking interest rates to combat inflation. By 2024, rates began to stabilize, but they remain elevated. And the Fed has been clear. It will not cut prematurely. So that means borrowing costs remain high. Capital is more expensive. And growth companies, especially unprofitable ones, are worth less in discounted cash flow models. In fact, this dynamic explains a huge part of ARKK's collapse from its 2021 highs. When the cost of capital rises, investors rotate out of long-duration assets like speculative tech and into safer, income-generating alternatives. Bonds become more attractive. Dividend-paying stocks become more attractive. Meanwhile, unprofitable tech gets hammered. Let's not forget what happened already. From February 2021 to October 2022, ARKK fell from $159 to around $30, an over 80% drawdown. That's not a temporary dip. That's a full-scale wipeout. And while the fund has had occasional rebounds, it has not returned to anywhere near its peak. But it's not just interest rates, it's fundamentals. According to ARK Invest's own data, the majority of their companies are not currently profitable. Some have negative free cash flow. Others have declining revenue growth. Many are reliant on continued capital raising to survive, and that becomes extremely difficult in a higher rate environment. Take CRISPR Therapeutics, another ARKK favorite. It's working on cutting-edge gene editing technology, which is promising, yes, but the business is still pre-commercial.
Right.
Where my actual one while I want a one 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 one. The path to profitability is uncertain. Biotech is notorious for binary outcomes. Clinical trial success or failure can make or break the company overnight. So what could 2025 bring? First, there's a real risk of a growth stock reversal. If inflation stays sticky and the Fed remains hawkish, growth stocks could come under renewed pressure. That alone would hit ARKK hard. Second, there's geopolitical risk. Semiconductor supply chains are still exposed to US-China tensions. AI chip exports are restricted. Taiwan remains a flashpoint. Any disruption in these areas affects key holdings like Nvidia-adjacent companies, and that ripples into ARKK's portfolio. Third, earnings risk. If some of ARKK's core holdings miss revenue targets or guide lower due to economic headwinds, the market will punish them. And since the fund is so concentrated with the top 10 holdings making up more than 60%, a few bad quarters can drag down the entire ETF. And here's something most investors overlook. Liquidity risk. Because ARK is actively managed, Cathie Wood has to sell positions when investors pull their money out. In volatile times, that creates downward pressure on share prices. During its worst periods, ARKK saw massive daily outflows, millions of dollars leaving the fund. Forcing the manager to sell illiquid volatile positions into weak markets, it's a self-reinforcing cycle. So what can you do? First, understand what ARKK really is. It's not a core portfolio building block. It's a higher risk thematic growth bet. If you own it, it should be a small percentage, maybe 2 to 5%, not your entire portfolio. Second, diversify. If you want exposure to tech and innovation, consider broader ETFs like QQQ or VGT, which hold many of the same companies, but with better balance, more stability, and less active risk. Third, set expectations. ARKK could outperform dramatically. It did in 2020, but it could also underperform dramatically. As it did in 2021 and 2022, you need to be okay with both outcomes. Fourth, don't confuse vision with valuation. Just because a company is working on cool stuff, AIE, VS, gene editing, doesn't mean it's a good investment at any price. Price matters, fundamentals matter, cash flow matters. In conclusion, ARKK is not doomed, but it is dangerous, especially in the wrong hands. In 2025, with macro risks, rising rates, geopolitical tension, and tightening liquidity, this ETF could once again destroy unprepared portfolios. Don't let the hype fool you. Know what you own and why. If you found this analysis useful, hit that like button, subscribe for more deep dives, and drop a comment below. Are you still bullish on ARKK, or are you staying far away? I'd love to hear what you think.